Welcome to you both. Paul, go ahead. Right now it's kind of calm out there in Bankland, but what do you foresee?
Well, Kelly, I see that because these unrealized losses are on the bank's balance sheet, they are constricted in terms of their ability to lend. They need to take steps to reduce expenses, and they're challenged on liquidity. They're borrowing from the Fed, the Federal Home Loan banks at high rates, and they need to have some relief there.
All right. So, Aaron, let me just kind of bring you in for some context here. And I know you're not a big fan of this argument, but help us make the case for why we might be heading to a point where something like this is being discussed. Are these unrealized losses, in other words, going to become very material over the next couple of years, or do you think banks can earn their way out of them?
So, look, I commend Paul for publishing a provocative piece in Bank Think. And he's right that a lot of bankers made some bad choices, bought a lot of low interest rate environment. And a lot of them are using the Federal Home Loan Bank system, as he describes, as kind of a backdoor way to get some money and some liquidity. Look, the biggest borrowers from the San Francisco Federal Home Loan Bank were SVB and First Republic, banks that were deep in this bad trade. But as you've seen, other banks, JP Morgan, Wells Fargo, Citibank, have reported positive earnings. And in fact, their stock prices have risen. So what you have is some banks made bad bets and they should suffer the consequences. Or as Paul said, bail out the people that made mistakes and reward the people that did well. I just think that, when you make a mistake, you should suffer the consequences. You shouldn't ask Uncle Sam to bail you out.
Although I might rejoinder to that, it might be, Aaron, that the banks took the bait, if I can quote Tom Honig, former Kansas City Fed president. I mean, treasuries are exempted from risk-weighted capital. They are encouraged, they are incentivized to go in and buy these. So, yes, somewhat further out in duration than others, B of A may be one of them, for instance. But, Paul, let me turn to you. Some would say that the banks have already had a bailout because the Fed is currently accepting a lot of this stuff at par. And in the past, it would be forcing some kind of discount. So aren't they already being given a bit of a bailout here?
Well, Kelly, if you look at what the banks are paying on this debt that they're taking out to meet their liquidity needs, deposits flowing out of the bank for a variety of reasons, their need to continue to fund loans, against what they're earning on those assets, there's probably a 300 basis point difference between there. So they're essentially losing money by borrowing from the Fed in order to maintain liquidity. And in looking at sort of what the banks did in terms of their investments, this is not a short-term problem. If you look at the maturities of some of these available for sale securities, they're extending out 10 years or longer. And to Aaron's point, this really isn't a Wall Street problem. This is a Wall Street and Main Street problem. There's a large number of smaller, mid-sized banks that are in this situation, and they have fewer options than the larger banks in terms of how to work their way out of it.
Yeah, Aaron, the other kind of dirty little secret of this whole affair is that, the government needs banks to hold treasuries, right? So whatever it's going to do here, it's ultimately got to find a buyer for more treasury bonds than it's ever had to find a buyer for at a time when the central bank has stepped back. If not banks, then who? They can't give it all to relative value hedge funds.
Well, look, interest rates have to be set by the markets, and at some point, deficits have consequences. It's not just treasuries. A lot of this was mortgage-backed securities, which were fed by the Federal Reserve, who pumped up mortgages, were buying mortgage securities in the name of COVID relief for a very long time after it was necessary. I mean, a lot of these problems, involve the Federal Reserve and their regulatory and failures at SVB and other places who are more loaded up on mortgage-backed securities than on treasuries. But per Paul's point, the bankers are great at playing possum and saying, oh, we're in trouble. The economy is going to suffer unless you bail us out. But don't touch our bonuses. Don't dilute our equity holders. Don't reduce our dividends. All in Paul's proposal. Just help us out. And, I'm sorry, but we're not going to get you out of this maze. You made the mistake. You have to figure out your own way.
Paul, quick last word. If nothing is done, and What do you think the ultimate problem could become here if we fast forward the clock?
Well, I think we can see some banks going under, and whether it's one large bank or a number of smaller banks, we could see them go under, and lending is going to be restricted, and it's just going to if we go into a recession, the bank's abilities to lend helps us get out of that.